I'm Rick Kaler. Thanks for joining me. The unpredictability of the COVID-19 virus, the drop in the stock market, the presidential elections. Alarmist news reports and expert predictions about the economic impacts of each. No wonder investors are feeling fearful. They've been hit with the perfect storm of three very emotional things coming together. When our brains perceive that our survival is threatened, rational thinking goes out the window. This was the case during the 2008 recession, and I think it's going to be even more true today, given the combination of the financial and medical uncertainties that we're facing. If you're feeling panic and an urge to get out of the markets, well, I think that's pretty normal at this juncture. But it may help you to ask a few questions of yourself. If you cash out, what will you do with the money? Now, let's say that you're retired or soon to be retired and you have $1 million in a diversified portfolio with 60% in stocks, real estate investment trusts, commodities, and maybe 40% in bonds and cash. Such a portfolio has generated about a 6% return since 2009. But given the frightening and uncertain future, the decline in the stock market, you're getting scared. And you think maybe I better preserve what I have because certainly it's going to continue to go down. I'll just get back in when things are better. So you need those funds. You need $36,000 a year or $3,000 a month in cash flow. What are your options? Well, if you cashed out, where are you going to put that cash? In a money market fund in your bank? Well, that's earning between 0.3, and if you're really lucky, I saw a rate yesterday at 1.8. But if you think about it, and we're on the verge of a catastrophe, is your bank really safe? Remember, anything over $250,000 is not FDIC guaranteed, so you're going to need to put your money in 4 different banks. Treasury bills would be safer, since they're backed by the U.S. government and not going to have a default. However, the very best bank money market funds and T-bill rates are paying about the same. Like I said, around 1.5% for T-bills and around 1.8% for the very best bank money markets. That's only going to generate, say, $15,000 a year or $1,250 a month, which is pretty short of what you need. Bank certificates of deposit, we call them CDs, are a little better, but the best ones are paying around 2%. I checked one major discount brokerage firm that was paying 1%. So that's only $10,000 or $20,000 annually, and it gives no protection against inflation, which is running at 2.6%. Well, a better option might be Treasury inflation protected securities called TIPS. These are 30-year bonds issued by the U.S. government. Again, pretty much default proof. And they will index their payout to inflation. And today they pay about an additional 0.25% over the inflation rate. So if inflation is, let's just call it 2.5% to make the math a little easier, and you're getting an extra premium of 0.25%, that's a total return of 2.75%, or $27,500 a year, or $2,300 a month. That's still short of what we need. AAA rated corporate bonds are yielding 2.13%, which still falls short of our long-term income needs. So all of these options would require you to begin depleting your principal. You really need to be earning 3 or 4% plus some growth to hit your cash flow target. Are there other higher return options? Well, high yield bonds would produce your desired return of maybe around 4 to 5%, but they have a threefold higher risk over AAA bonds of defaulting. The biggest risk of a corporate bond is, in addition to any default risk, which isn't huge, is that the company or inflation may erode the buying power in the future because it's a fixed rate and the rate isn't indexed to inflation. So if you're getting 3% on a long-term bond and inflation goes up to 3.5%, you're really losing 0.5% of purchasing power. Well, to guard against inflation, you could add some real estate investment trusts. Many of those are yielding 3 to 5%, which produces pretty close to the yield you need. Plus, real estate usually appreciates with inflation. So that sounds pretty good. You could even add some dividend-paying stocks, which are yielding, say, 2 to 3%. Plus, they probably will have some long-term appreciation that can keep up with inflation and maybe give you a return of 5 to 7% over a long period of time. So maybe the best option here is to add a little bit of each one of these categories. And altogether, you're probably going to get close enough to provide the income you need without depleting your principal. And have a little left over to increase the portfolio with inflation. But wait a minute. Isn't that exactly the type of portfolio you already own? The one that your fear is urging you to sell? Yeah, the answer is yes. So it's easy to panic if you focus on alarming news reports and predictions. So instead, try focusing on your present condition and the options you have today to generate income and recover from potential losses. Try looking at your current portfolio amount as if it were cash, and then ask yourself, if all I had today was cash, what would I do with it to generate the income I need? Thanks for listening.